Morning, guys. So this is Israel Keys Wealth, and this is Saturday, the 19th of October. As usual, on a Saturday morning, we're going to go through a review of the market activities in the foreign exchange last week, explaining what we saw, uh, and then a cast forward or look forward or preview to what we expect this week. Uh, it's been said several times on our platform that the key to a great trading week is the weekend before. And so before the week starts on Sunday night, you want to have looked at your charts, marked up your levels, and anticipated what you expect to happen moving forwards. This is how it works: anticipation, confirmation, execution. Write that down again: anticipation, confirmation, and execution. You want to be anticipating what the market's going to do, and then waiting for it to give you confirmation, and then you can step in with high levels of confidence as you take a trade. You will lose some, that's fine, but you will win more than you lose if you have good informed price action and sometimes fundamental analysis in your favor. And also, if you remember real quick, we've made it very clear that you want to be taking trades where your risk to reward ratio is minimum 2 to 1. I prefer a minimum of 3 to 1. 3 to 1 means I can take 3 trades that week and be wrong on 2 and still be profitable. I would need to lose all 3. And it's very unlikely that if you have good risk management, you have good trade psychology, and you have good technical and fundamental analysis on your side, that you take 3 well-informed trades and lose all 3. So with that being said, let's go straight into the markets. Um, so let's look at what happened last week. If you watch the video to the analysis of last week and it's somewhere in the channel, we look like gangbusters. We look like prophets. We look like Nostradamus because we pretty much called what the market did. And so, as usual, let's start with the US dollar index. Now, I warn you in advance, I have marked up some of my charts in advance to make it easier for me, but just follow me as we go along. And so, now, because I am primarily a I am primarily a intra-week and intra-day trader, I start my analysis from the weekly time frame. I usually don't pay too much attention to the monthly. Now, if you're a swing trader, if you trade in a higher time frame like swing trading or more, you definitely do want to look at the monthly. But I find that for my analysis, what I do, uh, the weekly will do just fine because most of the key monthly levels will show up on the weekly chart anyway. Now, as usual, this is my demo account. I don't want to show you my live for several reasons, but this is my demo account, and you should, if you're just learning to trade or trying to refine some of the concepts that we teach, we recommend wholeheartedly that you trade with a demo account. You want to be clear on how you are formulating your trade plans and your strategies for at least 2 to 3 months before you move over to a live account. And for those of you who haven't heard this before, yes, you do want to have a clear trading strategy and plan. It should be so clear you can write it down on half an A4 piece of paper. It should include a scenario that you expect to play out on a higher time frame. It should include, first of all, it should include levels, key levels of interest on the highest time frame you analyze. It should include a scenario you expect to play out on a time frame that is lower than that higher time frame you analyze. And then it should include a trigger or a signal on your execution time frame, which again is a lower time frame. So you want to have a triad of time frames, 3, one for levels, one for scenarios, and a third for execution. So for instance, my style of trading personally, I will go weekly 4-hour 15 minutes or daily 1 hour 15 minutes. And whichever way I'm going, I'll still look at the daily candles just to give me some set of analysis, or a sense of directional bias for that particular trading day. Because I approach, even when I'm in intra-week trades, I approach my my approach means that I want to see what direction we're going in that particular day. So having said that, first of all, let's start with the US dollar index. Like I said, because of time, you know what? I'm just going to move these out of the way real quick so they don't get involved in, or they don't get in your way, so you can see what I'm talking about. But on my chart, purple lines are 4 hours. Brown, dark brown, called saddleback lines are the weeklies. And this that you see here is, okay, I'm going to take that out of the way as well because it's getting in your way. Cool. So this is how I started. So I looked at the week now. Bear in mind, as of last week, we did not have this huge candle that has just come into the marketplace. We didn't have that. This is what we looked at last week. So based on last week, I had mentioned the fact that the dollar index to start the week was likely to be choppy. And so I was going to give it a few days to show its hand. However, I marked out my weekly levels, that one there. I also marked out this one here, which I'll show you, but I took it off as the week progressed because I realized it wasn't going to be too necessary. So that one over there. And so what I said I was looking for was the dollar to push up into this area. This is the US dollar index. It tracks the dollar. And since I trade mostly majors, I use that as a directional filter. I was looking for it to push up into this area. And based on its reaction, I would know whether or not it was going to go up and challenge this level here, or it was going to fall out of bed. As it turned out, it did push up on a Monday and a Tuesday, and then it fell out of bed as I suspected it would. But forget about that. So in essence, that's what we would have looked at. Now, on that basis, these are the levels that I drew out. First of all, that here, so basically weekly highs and lows in that range, and bodies and wicks of candles. So I delineated this level here, and you can look at how price respected that perfectly. That's the low of this candle over here. Just draw it out in time. Like I said, if you don't like drawing highs and lows, you don't want to make money. So just drew that out. That was pretty much obviously same level there as well. So that's where price opened. It went up there and came back and then dropped like stone. And I also marked out these levels as well. Now, price blew through them. That tells me that to start next week, I expect a little bit of a drop down into at least this level here. At the very least, this level there. And then at that point, we'll figure out what we do next. It'll tell us clearly, let me just put these in brown. It'll tell us clearly what it wants to do. And so, like I said, this is the anticipatory skill. You want to know what levels, and also not in the purview of today's analysis, but what levels and what times of the day or the week these levels are likely to be reached. You then want to wait for clear confirmation, and I use the word clear. Don't jump the gun. Price is not ambiguous. The marketplace and the factors and the drivers that move it are very precise in their movement. And if you allow them, they will show you their hand very clearly. Do not jump the gun. And so based on the size of that candle, you can see that this was a small candle, this is a slightly bigger candle, this is becoming even bigger. So we're gaining momentum. Now, when we get in here, I want to see what happens to that momentum. But if price is so inclined to do what it's doing now, also there are other factors on a macro basis which I'm not going to cover in this analysis. You do get some of what you pay for, and there's some macro analysis factors that I factor into my trading as well. But this is a free session, so you're not going to get that here. But there's a very good chance that because of the size of that candle, it could be gain momentum and just blow through here. So if that happens, we got to be ready. to meet it further down the road. My favorite analysis is think of it as a bus, and you don't want to be chasing the bus while it's in space. You want to go wait for it at predefined bus stops. So there's places on the bus route where the bus driver will stop. You know he will stop at those places. Don't stand in the middle of the road running after saying stop. Just go wait for him on the next bus stop and then get on board. And so whether price is going up or down, even if it's going to go all the way through here, at each of these levels, I expect some sort of significant movement or reaction, which tells me it's either reversing or it's picking up steam. And each of these levels should give me, whether I want to go short or long based on what it's telling me, should give me a clear direction. I don't want to draw too many of them, but I just will, because there is also a chance that it could, even if it's going south, it is likely to come back up at some point. Anyway, so those are the levels I'm interested in for now. There's a few other ones which I'm not going to go into. We'll see them on a lower time frame if necessary. So there we go. So let's go into see what happened in the week. Check out so far our chart. Actually, I should have waited to look at what happened last week before I put those new levels in, but it's all good. So this is what happened on the 4-hour chart. Price opened here. So it closed there for the week and it gapped down and started opening. So there was a gap of at least roughly on the US dollar, okay, a pip, two pips, but it was slightly more significant in all the major pairs. That told me that at the very least, price was coming down to close that gap at some point during the week. And I said that in the video, and it did. Now, it did a lot more than that, but hey, there we go. Based on the analysis here, each of this is a weekly low. So that's why I go from a weekly to a 4-hour, because each divider on a 4-hour chart is a week. And so we started here. We went up through the weekly low of last week. In the process, took out a 4-hour high and rejected back through that level there. And this was the area of supply zone that happened in. That says to me very clearly, and that happened, well, okay, I'm not going to go into all that, but you can see that level there coincided with the body of that 4-hour candle. This is textbook price action. And so if we expect a short week, we've spoken about this before, we expect some sort of manipulation. So we expect price to go fake us out one way and then go the way it wants to go. It doesn't always happen, but 70% of the time it does. And even if it's not going to happen by Tuesday, at the very least, or Wednesday, we'll see that. But this was textbook price action. So it went up, hunted liquidity in there. This is where these markings are. Yeah, so there we go. So there is the 4-hour stop hunt that we were anticipating at this level here. It took out this 4-hour high here, and it ran to that block of orders there, that supply zone, nicked just above this close there, and then pushed right back through that candle. So we had two options to take a trade. If we were pressed for time and were purely intra-week traders and didn't have the time to refine anything, this would have been the way to go about it. We would have put our entry there at the close of the 4-hour candle. We would have put our high either above that zone, there, which would have been roughly a 40 pip stop. And we would have made 1, 2, well, actually, we're not trading the US dollar. I forgot about that. But so I'll show you that on the majors. Actually, we shouldn't be doing entries and exits because you don't trade the US dollar index. It's just a tool to give you clarity on what's happening in the week. But textbook price action and the dollar fell out of bed. If the dollar fell out of bed, then we expect all the majors to move accordingly. So I count 6 majors, some people count 5. I include the Kiwi, the US dollar against the New Zealand dollar against the US dollar. And so these are the majors down beneath my screen here. That's the Kiwi there, the dollar, the US dollar against the New Zealand dollar. That's the dollar index. That's the Australian dollar, US dollar. That's the US dollar CAD. And each of them has a direction that it will go based on what the US dollar index does. So for instance, New Zealand US. So US is the reference pair there, not the base pair. In that case, if the dollar is going down, we expect the New Zealand US dollar to go up because the New Zealand dollar is the first currency in the pair. On the flip side, the US dollar CAD, the dollar is the first currency in the pair. So if the US dollar is going down, we expect the USD CAD to go down. And what do we know? Let's go through the week. Let's go for our basis. And so, as we can see, and I'll show you what this means in a second, the New Zealand dollar did go up as we expect, because if the dollar is going down, then we expect the New Zealand to go up against it. So it did go up. It went up to the tune of the entire weekly range was 138 pips. Think about that. You had 138 pips to play with if you could get a refined entry and exit. The Australian dollar did the same. It went up as well. And it went up to the tune of 134 pips. The US CAD we'd expect to go down since the dollar is going down. And what do you know? It did go down. And the entire weekly range again was to the tune of about 118 pips. You get the point. The pound dollar would expect to go up against the US dollar since it was going down. And this one was a barnstormer. This was one of the best performers of the week because the price action was textbook. And it went up 468 points. And that's good for me because I live in the UK. So now you'd say, well, that was fundamental news. It was Brexit. True. That was what made it travel that far. But you can see how fundamentals and technicals work in concert because the technicals told us that the dollar was going down. So you expect the GU to go down or go up. But it went up much further than the rest because of the fundamentals. And that's how you build trade ideas. Also, if you trade crosses, say, for instance, you were trading the pound against the Aussie, you would see, let me show you that real quick, that the pound dollar against the Aussie dollar, you would expect that to go up as well, or the pound, sorry, against the Aussie dollar. You'd expect that to go up as well because it looked like the pound did much better against its relative strength against the dollar. Write that down, relative strength against the dollar was better than the Aussie. So let's look at that, GBAUD, there we go. So that's the pair there. And this is how you trade crosses. I don't like to trade them, but if you do trade crosses, you definitely want to be ensuring that you are checking what each individual currency in your cross pair is doing against the dollar, because the dollar is the reference point for all currency pairs. And so there we go. As you can see, it started down there and it went up roughly 572 pips. Now, there was a little bit of a correction during the week, as you'd expect, some profit taking, but then it shot up again, and so it closed 413 pips up. So even if you sat through all this drawdown, you would have still closed 400 pips. What could 400 pips do for your trading account? You tell me. I'll leave you to figure that out. So anyway, I'm going to take that off my chart because of my screen, because I don't trade that pair. And the Swissy, again, you'd expect that to go down. It did go down. You want to see how far it went down roughly 150 pips, and the EU would expect to go up, and that also went up. Again, textbook price action, one of the better performers of the week. It went up about 180 pips. So we got that just by analyzing the US dollar wick. Now, let's go back to the dollar index. I want to show you something very interesting that I haven't shown you yet. For those of you who are part of my coaching group, I might just make this video coaching group only, because there's some sweet insight here that I really don't want to give away for free. So there's the dollar index. There's the 4-hour chart. If you go back to this here, it's where this writings, why I put this writings there. If you're an intra-week trader, again, you can refine this down to intraday basis. I'll look at those in the coming weeks. But for those of you in my group, we want to build on the basics slowly. We'll build on that slowly. So let's focus on the intra-week. Now, if you are a trader, write this down. You expect the high or the low of the week 70% of the time to form sometime between Tuesday and Wednesday. It's not always the case. Sometimes it forms on Monday and runs away. Sometimes it waits till Thursday. But if you are trading directional bias, you want to be staring at Tuesday and Wednesday, because that is usually where, in a textbook week, the high or the low of the week will form. Now, a mentor of mine, ICT trader, Inner Circle trader, Michael Huddleston, came up with a term called a Z day. I've applied that to a Z week. It's a week where there's no clear direction, where price goes one way and then comes back the other way. And so if you are trading directionally, it might have stopped you out either way. And those are manipulations market makers use to to engineer liquidity. But 7 times out of 10, you have a textbook week. It moves one way first, makes a higher or low, and comes back the other way. And so you go wait for it at the turning point, and you make the most profit. Now, this week, it formed on a Tuesday. You see that there? That stop hunt, that successful stop hunt, and a push back down. And how do you know it's a successful stop hunt? You drop down from the 4-hour to the 1-hour or the 30 minutes, and you look for what I call a market structure break. Again, this is a phrase I took from the free mentorship work of a mentor of mine, Inner Circle trader. Myself and a couple of my trading friends studied his work years ago, and we've borrowed some of his concepts, which you can find for free on the internet. So a market structure break. What is a market structure break? If you remember the lesson we did on retracement and impulse swings, we expect price to move in swings, meaning if it's an uptrend, you expect a high and then a retracement and then a higher high and then a retracement and then another higher high. You can see here that price was going up. So here it made a higher high than this high here. This swing high here was violated there, and then a sharp rejection to the downside. And it took out this low here. That is a market structure break. And when that happens in a stop hunt, a 4-hour stop hunt, it's magic. So here, there's a 4-hour high here. That's why this candle's in purple. Price went above it. There have been liquidity resting there, stop orders, stop losses, or breakout traders looking to go to the upside. Those who are selling would have put a stop loss there, meaning it would have been a buy stop. Those looking to be breakout traders would have put a buy stop to go long. And so a market maker wanting to sell would have a huge amount of buy liquidity here. And so they tapped into that and it dropped like a stone. It took out this level there. That becomes a market structure break. but you can refine it further down to a 15-minute chart to really see it to get in early. And on the 15-minute chart, you have in either of these three lows there that this market structure line would have been valid for. You got that one. If you're bold, you got that other one there. Now, I would have waited for this one because this is a little bit choppy. You can see that's a consolidation there. I wouldn't trust that. This is more clearly defined. And you can also see that this one here was also respected clearly. Now, if you missed this all the way down here, you got a very simple way to get back in the move. Just put this here or here and wait for price to break above it and close clearly beneath it again. No time to explain that, but so if you missed this, all this here, rather than take the trade from there, which is a wide stop, that's a very wide stop there in terms of on the other pairs, on the main pairs. If we're to break back above it and then close clearly beneath it, and that clear close would have been here, and then put the stop above that next high there. But anyway, those are tricks of the trade. But you can see that there's a clear market structure break there on the lower time frame, which makes it a valid 4-hour signal. And at that point, you would then be chasing shorts to close the weekly range. And where would your targets be? That's why I wish I'd taken off these ones. Let me take those off here for now. Really, anyway, just leave them in. So I want you to look at what price does every time it gets to one of these weekly levels, which are also 4-hour levels here. And there's one that the week didn't show. I told you I didn't show every single one of them, that they would become more apparent on the 4-hour chart. Now, since our execution is going to be on a 15-minute chart, we want to mark out these 4-hour levels. Make that clear. And we also want to see the distinction between a 4-hour level and a weekly level, because price pays one more respect than the other. And so we know our bias is short. So we're hunting shorts during the week. We're looking, in essence, we're not concerned with these little rallies. Now, I trade them if I miss, because this week I kept waking up too late in the morning or being at work in the afternoon when the main downward moves were happening. So I was fading the retracements, but that's very dangerous. If you're a new trader, please don't do that, because yes, you could get what here. Again, this is the dollar index, but on the charts, you would see some opportunities to take these retracements long, but they're dangerous. You want to be using them as an opportunity to line up for another short. And there you go. And finally, this line is there for a reason. I want to show you that high of the week in a short week formed at, let's go there. Let's go to the 15-minute chart, or the 1-hour chart. We'll do. It formed at 5 p.m. server time. Now, my trading broker server is 2 hours ahead of mine, so that would have been 3 p.m. my time in the United Kingdom, which is a very significant time frame. There are two time frames you want to be looking at primarily. You want to be looking at the London session, and especially the open of the London session, which is roughly between 6 and 10 a.m. in the morning in the UK. And you want to be looking at the open of the UK or the US or the New York session, which is roughly between 1 p.m. and 3 p.m., sometimes 12:30 to 3:30. Those are the times you are you should be eyeballing your chart. I've explained in previous videos why. The simple answer is, first of all, the two major commercial centers around the world are London and New York. Tokyo's a third, but it's a distant third. Secondly, the times of the London Open and the New York Open are times when there are multiple sessions open. Asia, Europe, and North America converge. You have these three sessions at work, usually around these times, and specifically also in New York. If you find it too early to wake up or you're too busy in the morning, you might miss a few good moves, but if you wait for the New York session, you usually get a chance to follow through. And so that happened at 5 p.m. server time on Tuesday on the dollar index. Let's look at all the majors. On the EU, that same low of the week on the EU was roughly 5 p.m. on a Tuesday. Now, if it's the high on the dollar, it should be the low on the EU, 5 p.m. on a Tuesday. On the Swissy, the high, that's directly correlated because the dollar is the first pair. The high was 5 p.m. on a Tuesday. On the GU, 1 second. Yep, on the GU, the low of the week was also roughly 5 p.m. on a Tuesday. Now, the GU was slightly different, and I'm going to talk about that in a second. You can usually tell the pairs that are really going to do something crazy by how they break this correlation. So each major should be correlated to the dollar. There was a slight break in the correlation in the GU in that it went lower on a Monday. But if you look at the 5 p.m. on a Tuesday, it still gave you a perfect trading opportunity there. So that's a break in the correlation in that you would have missed the exact low of the week, but you still see that from that point on Friday, on Tuesday, 5 p.m., price never gets back to that point. So that would still have been a valid trade point for you. US CAD, the high is roughly 5 p.m. on a Tuesday. Aussie, now, the Aussie dollar, to do 1 quick second. The Aussie dollar and the New Zealand dollar, which are two directly correlated pairs, they cracked that correlation. Price dipped below that to engineer some more liquidity. But look at what that line does there. The moment price comes back through that line, this is an advanced concept which we will look at in the future. For now, just ignore it for now. But that is a very powerful signal. When that happened there and didn't happen in the rest of it happened in New Zealand as well. I'll show you that there. It also happened in New Zealand as well. There you go. But when that happens in these two pairs that are in the same part of the world, but it didn't happen anywhere else. I've left the Jappy out. Where's the US Jappy? Well, anyway, I'll show you. The exact same thing happened in the Jappy. The Jappy followed the rest of the majors. Once that happens and price breaks back above that, in essence, this happens, but it doesn't happen in any of the other majors. You know that that is a currency-specific move. In essence, something is happening in that specific currency that is not happening it's not tied to the dollar. That is even more confirmation for you. The moment price breaks back above this level, you should have all the confidence in the world. Even if you were in this trade here and then you took this loss, but this happened and it breaks back up with a huge candle above that level, you can book it and go to sleep. You don't need any more confirmation. So even if you took a 1% loss at that point in the week, which is why you don't want to take more than a 1 or 2% loss per trade, you then have the power to do this. And look at that. The price of the information you gained from a 1% loss. They're giving you 1, 2, 3, 4, 5, 6, and nearly 7. What's 6? Let's assume you stopped at 6. What's 6 minus 1? 5. You would have ended up 5% higher that week by observing this crack in correlation there. So that's a powerful tool, but more on it in the future. So that's how we get the direction for the week in a textbook week. Not all weeks are textbook. Some weeks are choppy, but if you can see most of the weeks here, you see price starts there, it goes up, then drops, it retraces, but you catch this move and you're out. Here, it comes down and then rises. So you'd want to be in somewhere there. There, it drops down, you'd be in around there, and then it rises. Here, it goes up pretty much from the beginning of the week. So this is a non-textbook week, but we have skills to trade that we'll learn in the future. This, again, it comes up here, it goes up, and then drops. Here, it just literally rises all the way up there and it drops. So you might have missed this move, but then you can get the one on the way down. Here, same thing, it goes up and then comes back down. So you get in there, come down there. Here, it goes down on day one and just rises all the way through. This might be a week where you got faked out, but then there'd be other currency. So in essence, a non-textbook week on one pair would still, on most pairs, would still usually give you one major you can trade in a textbook way. Right, so let's dive into more detail now. This particular week, I was stalking the GU, the EU, and the Swissy. And we've looked at what happened on the textbook side. Now let's look at some, 1 second. Let's look at some more specific price action. Just trying to find out which particular chart I used for this. I think, no, well, okay. So this was the chart I started off last week with. It's marked all over the place. It probably wouldn't give you much information, but let's see if we can, if there's anything we can glean from it. I'm leaving that there to show you that this is not hindsight. This is stuff that I did before the week began. All right, let's just, okay. So the MTWs, those are from the previous week. This is the week we're looking at. And you know what, I just, that's too, it's not clean enough. So let me start again. I just hate having to do it all over and over again because I do it several times over the course. Actually, I know what to do. I did put these, I took screenshots during the course of the week that we can look at. So let's go into those screenshots to save me the effort of having to mark up these charts again. And again, it just shows you that this is predictable, extremely predictable. So, right, what am I looking for? Okay, Exhibit A. There we go. So this is a screenshot I took. I took this at the end of the week while I was working with one of the members of my mentorship group on a one-on-one basis. And for those of you who don't know, I do one-on-one classes. So if you want to get in touch with me so I can give you some personal attention. Right, and so this was how I started the week. Now at that time, this candle here hadn't formed, but this was the open of the week here. And so I drew out that line there from 3 weeks ago and from last week, and that candle up there. Now, price gave us a nice weekly engulfing, meaning this big candle here was violated to the downside. Also, this candle as well also took out the previous week's low and closed beneath it. That's important. It closed beneath it. And so to start the week, based on the price action I had seen, I was of the opinion price was going to stab up in here. Now, it could have reversed. It could have come down because we were in this block here. Could have come down into this block there, taken some orders and gone to the north side. And if it did that, then we would have seen clearly what it was looking to do to start the week. Because anyway, but this was the preferred guess to go further down, and in so doing, we expect the price to come back in here, somewhere in this candle, but pretty much above the high of it, and tapping into here to borrow. I use the word borrow or steal some liquidity. So it did that, and then it dropped. And I had marked out these two levels as where I expected price to find some support during the week. Once it came here, at this point was going to be the end of my weekly range. And as you can see, it stabbed through it, but it never got there, and it closed there. So that's the weekly analysis. Let's dive a bit deeper. And so we go into a 4-hour chart, as I showed you with the dollar index. So that's a 4-hour chart. And we were waiting. Those are the same lines you saw on the weekly. See those lines there on the weekly? Those lines there? This is what they look like on a 4-hour chart. And remember, one weekly candle is one period divider on a 4-hour chart. That's why the two time frames are very closely correlated. And so there we go. This is where price started the week. There was a gap there of a fairly significant gap. And as we can see, it started to push up. No, this is the dollar index. Sorry, no, I've shown you this already. Forgive me. No, I'm looking for the EU pair. This is the dollar index. I've realized, and I've shown you this already. I've shown you this already. 1 second. Where's my EU chart? There we go. Actually, I did this on, 1 second. I did this on the US JAPI, so that's what I'm going to show you. The US JAPI, when I'm showing the EU live. So there we go. So same sort of analysis. Again, this was before the week started. We're expecting price to push up in that general direction. And so we drop down to 4-hour level. And at that time of the day on a Thursday, this was on a Thursday I did this. This is what the 4-hour done. It started there. It went up. It went down first, sorry, and then it took off. And so you anticipate where the stop hunt's going to take place. You might be wrong, but you anticipate. Now, as you can see, it started the week there, and it came and took out this. First of all, it took out this stop hunt here. It took out this candle, then dropped in, and it went back up. So we're patient. We're still waiting for a valid stop hunt, and then it comes back down and takes out this again. Either of these two would have been valid, but this would have been a valid signal. You put your stop there, and it expands to the upside, which it did. But we would not have traded the JAPI because we were looking primarily for, remember I said we're looking for a drop in the dollar. So that's why the Japanese yen was going against it, fighting uphill, because the price action is textbook, but it's going against the dollar direction, and so we didn't see too much of an expansion, which was why I left it off my majors chart. Now I'm gonna have to do this, not being lazy. Let's go into the charts and show what happened. I'm just gonna have to do this again, which is fine. So let's clear this completely and start from scratch. Good. So again, to start the week, that huge weekly candle you've just seen would not have been in our purview. That's all we would have seen to start the week. And what do we see here? We see that the previous week had given us a nice engulfing candle that did two things. I'm just gonna put that there. At least you know that we didn't see that candle. But it did two things. First of all, it took out that bearish candle there, creating, again, in the words of one of my mentors, a bullish order block or a demand zone. And it closed above it. That's important. You want to see it close above that level there. Secondly, it also closed above the high of the previous week. Those two levels are very important. Those two levels are very, very important. This here is a clear bullish signal. Just these three candles here, before this fourth one started, these three candles here on a weekly time frame, also on the daily time frame if you're an intraday trader, but on a weekly time frame, this is gold. You can 75 to 80% times book it. So this is gold. And when you see this, so you know you're going long. When you see this, your question should be, where is the weekly objective? Where is this likely to reach? During the week, I would have drawn this out as well, because if price ever came back there, then I know I have a problem. So if I'm in a trade or I'm waiting for something, if price were to break beyond that, and it's not a stop hunt at this point, then I know I got the direction wrong and I'm going back the other way. Also, a neat trick is actually, no, let me take that away. You don't even need that. So you don't even need that. So that's there. Where we go into, where there's two areas that are very, very obvious. This is one, that high there, which is why you mark out weekly highs and lows. Now, these are supposed to be brown, but I don't have the time to change the colors. I'm just going to make them purple for now. And then I'll change the color on the 4 hour just so that there and this there. Now, we broke through and closed above that one there. So I expect us to challenge, at least challenge this one here. And so we've got roughly another, at least it could blow it out and come up here, but at least roughly 80 pips. So let's be content, at least 50 pips to work with during the week, somewhere in this range here. And if we start to see bearish signs, then we adjust accordingly. But anyway, so pairing this with the dollar, so we see this price action along with what we saw in the dollar's price action. Let's go here. In the dollar's price action, and which would have been this same thing here, that took out that there. Now this was pretty much equidistant, but that's fine. in fact, they took out that and also that. So in essence, we expect the dollar to go down. We come and look at the EU, and we see that the EU is telling us that it wants to go up. And so we expected a long week. The question now is, if it's going up, we expect it to drop down, find liquidity somewhere. Where is it likely to find liquidity? Somewhere around these levels I've just drawn. Beneath that level there, or beneath this one there. So you watch these two levels during the week. You watch them very clearly. You start to stalk them. We drop down to a 4-hour chart. And those are those same two levels here. You can see them clearly. And what does price do? It starts up there. It gets to the first one, but there's no clear direction on the 4-hour. See, it's wicking about. So that you want to see a clear, strong direction. It doesn't. Now, you could have, if you wanted to take a trade down there, right, around this level, you would have lost 1%. But then again, even if you lost 1%, like I told you, sometimes the losses pay for themselves with the information they give you. And then it then behaves the way you expect it to behave at that point. If you lost 1% on that early entry, which being a Monday, I wouldn't have trusted anyway with this kind of behavior. If this had happened on a Tuesday, I'd be more inclined. But being a Monday, you make 1, 2, 3, and almost 4 just on that wide 40 pip stop. That's plus 3%. But we're going to refine that even further. And so it gets the second one, and this is where the magic happens. At this second level, there are 2 4-hour stop hunts. Look at this at this second level. First of all, this is a swing low. See, it's a low with candles higher on each side. And this is another swing low. Let me put them in. Let me put a shape in so you can see that real clear. That's one there. That's one there. And that's another there. You see that? And so it took this one, right? But it kept going further down, and it came and took that one, which was perfectly lined up with that line we drew. And then there is a strong reaction. So like I said, you have 2 options. Option 1 is, I can't be bothered to refine the trade. You get in there. You put your stop there. And you go 1, 2, 3, 4, almost 5. It's a textbook action. We're expecting a long. We expect price to manipulate short and then take off. And we're looking for liquidity run to give us a directional premise. But this is what I did. I went down even further. First of all, you want to test this out. I'm looking for a 15-minute market structure break at around that time. And what do you know? There you have it. There's your 15-minute market structure break. Takes out that high and then that high. And it goes above that level there. So to refine it on the 15-minute chart, this is the market structure break that I would have looked for. Because 1, it's above the stop hunt level. 2, it's a clear high, or if you wanted to be more pedantic, you could have gone for that one there. And as you can see, if you missed it first, it comes back down and dips into that level and then starts to take off again. So if you missed it going up this way and you wait for it to come back down in there and then go back above the same level again, you can then put your stop loss You could then put your stop loss. So if you would enter it when it closed back above there, and you put your stop loss beneath that low there. And I mean, 1, 2, 3, 4, 5, 6, 7, 8, and counting 9, 10, 11, 12. Now, this is just ridiculous, right? And where did it end up going back to? Let's look at this in the 4-hour chart. So where would your profit taking objectives be on the 4-hour chart? Well, the first one would be back to the first high there. And so you'd be looking to close a trade at some point there, but then it blows through that. So it's telling you, I'm not done yet. And so you could have gotten in again there. Let's assume you close the trade here, right? In fact, you would have seen this happen. So you would have thought it was still going further up, and then it came back down again. So let's assume you closed it there. The moment it does this again, it engulfs again. For the new traders, we'll talk about engulfing in more detail. You're back in again, and then you could make another 1, 2, and almost 3. And that's just going for 4-hour chart. But I'm going to show you now what I didn't show you last week, how to refine this even further. Let's go to a 15-minute chart. Now, let's go to a daily chart. So this is how you get your ins and outs during the day. Now, on a daily chart, this is where the week began. So this was the beginning of the week there. I believe this was Monday. Let me just check. Was that Monday? Friday, Thursday, Wednesday, Tuesday, Monday. This Monday here? Let's go to the daily. 1 second, let's go back. So this was the 14th of October. Let's go to the daily. Okay, that was Tuesday. Excellent. That was Tuesday. Now, on the daily, you would have sat Monday out, obviously, and potentially even sat Tuesday out. The moment you get this beautiful reaction, so this was a stop hunt on the Tuesday, so you would not have participated in that. That's fine. I can show you how to participate in it if you want to see it, but you will not have participated in that, and that's fine. Because now it happens Tuesday, 3 p.m. So if you weren't in front of your charts Tuesday, 3 p.m., and you came back from work in the evening and you saw that, now you just are waiting for candy on a Wednesday. And so this is Wednesday. You see, went up on Wednesday, went up on Thursday, went up on Friday. How do you know that's going to happen? Drop down to a 15-minute chart. If you're a day trader, you really need to get a good handle on the 15-minute chart. So this is Tuesday. This is a Tuesday here. On Wednesday, keeping those same weekly levels in place. If you expect price to go up, you want it to first come down. Now, this, I'm not going to teach you about this right now. I'm not going to confuse you. But for the experienced traders, just know that this is the Asian range. So this here is the Asian range. That's the Asian time frame. If I'm going long on a textbook day, I'm waiting for price to give me an entry at or beneath the Asian range. So, and especially since that's the stop hunt line, this is my trigger. While it was going up, I'm not interested. But if you do want to chase it, look at where it stops. Usually, this is a pip, I think, 1 pip or 2 pips beneath that level. And that's really to cover the spread. Again, I'll explain what the spread means in more detail later. That's to cover the spread. But don't chase that. But even if you chased it, right, fine. Bear in mind that that's there. Take your profit there for the day and go. So once it comes there, usually 3 to 5 pips before that. So, but then this is the danger. If you woke up in the morning, so let's see, this is 8:30, so this is 6:30 our time. So this is 7 o'clock our time. This is where you are. You're already above the Asian high. Put your stop beneath it, 10 pips. You make a good almost 3 to 1. That's not bad. But this is a day that if it kept going, I would have been inclined to leave alone. But look, it comes back. And what does it come back to? Back to that level there. And then it gives a sharp reaction. Bingo. And so you are in here. No fear. If you lose, you've only put 1% down on the table. You are in there. Your stop loss is either there because you assume that to be the low of the day. The more conservative stop loss, we're going to put it beneath this previous low there, because that is the area of liquidity that engineered this move. Price starts here, comes in there, and gets its liquidity in that area. And so safely, 1, 2, 3, 3.5 on Tuesday. It usually by 5 p.m., 6 p.m. in the UK, you want to be closing your trade, whatever it's done. What's the time there? So that's 8 o'clock server time, so that's 6 p.m. UK. So literally at this point, you would have closed for the day. That's just over 3%. If you took the aggressive trade, you get 1, 2, 3, 4, 5, 6.5. But bear in mind, there's a good chance that you would have lost money if price, because price could very easily have come and stabbed beneath that. Also, I want to see an intraday stop hunt when I'm taking my entries on an intraday basis. So that's an intraday low that was formed in Asia. I want to see price go and take that out and respect that level there. But Wednesday is where the magic really happens. This is textbook on Wednesday. We open, and so you'd close there for the day. If you're a day trader, you're not going to sit through this overnight. You're not going to pay swaps, because every time you spend time overnight in the marketplace, you pay a little bit of a commission. And this is textbook, right? This is just beautiful. First of all, look at the time. That is 10 a.m. server time. That's 8 a.m. in the UK. Perfect. It takes out the Asian low. You can see that there. Comes back near this level that we've already drawn out. So we know, bear in mind, these levels are already drawn from the beginning of the week. Takes out that level there and has a strong reaction on the 15-minute candle. And so our entry is at the close of the candle. Our stop loss is beneath that level. So that would have been 15 pips, or there. You can see that that's what's engineering that there, although it came back to it. But to be on the safe side, I would just put it beneath that level there. And then you get 1, 2, 3, 4, pretty much 4. Now, if you missed the London entry, which was roughly 8 a.m. in the UK or West Africa, look at what happened here. This is 3:15 in the UK, so that would be 1:15, or 3:15 server time. That'd be 1:15 in the UK. I told you New York will usually give you another entry, and at that point, there is a retracement from the high formed in London, and then there is another sharp reaction. Now, this is where it gets a little bit tricky. You see this here? This could have been the reaction. And if you put your stop there, you would have lost money. This might not look too sensible or make too much sense, but it will as we get further into our time together. That, first of all, is where I would have been putting my stop, the bottom of that big candle, because this candle here is controlling this liquidity. And secondly, I want to see another stop hunt. I want to see a low form, and then a low that takes it out. But you could argue that this one forms and then this one takes it out. But for me, looking at this, this is the obvious one here. And then your entries here. Your entry is then here at the close of that candle. That's your stop loss, or there. And as you can see, it really wouldn't have given you just 1% for the day. Just something to say, okay, I missed out on London. It doesn't always give you that. Now, the conservative way to do it would be, okay, so this is now the low forming that. I'm waiting for a retracement. This is the beginning of our Fibonacci time. For the experienced traders, you know what I'm doing. New ones, you'll find out that Fibonacci is a beautiful tool. And so it comes, actually, this is where it would have come here, there. To the 61.8 retracement level. And so my entry would have been there. My stop loss would have been just there. And I would have made almost 2%. But that would be a scalp. So when I send you pictures of me getting just a little bit of when I say, hey, just a short trade because I missed the main move for the day, that's how I get those little scalps to make sure the day is not a complete waste. And then we move to Friday. Again, remember, this was our ultimate. So this was our first objective during the week. Remember that, right? This is our first objective during the week. So when we get here, on a daily basis, we would get out. So we would have gotten out on, this is Friday, Thursday, Tuesday. So we'll have gotten out on Tuesday here. And once Wednesday does this, right? We know we're not coming back there. We know that we're heading for our next objective. Now, usually I don't like to trade Fridays. One, some kinds of news. Secondly, that's the time where it starts to reverse. But on a day like this where we've not reached our objective, in a week we've not reached our objective on a Friday, again, wait for the day to start, wait for Asia to form, wait for the Asian range to be violated to engineer liquidity here. What are you looking for? You're looking for a point of reference on the previous day, either a pre-week level or a previous day's low. So that there. And also that one there. And so once this forms, you are, again, wait for the candle to close. Once the candle closes at that point there, that's your entry. Your stop loss goes either there, or if you want to be ultra safe, ultra safe, it would go there. In which case you'd get 2% for the week. You could put it there to be ultra aggressive. And this is the beauty of that 1, 2, 3, 4, 5, almost 6 just that day. But it could, 4 times, 3 times out of 10, it'll take that out. So if you don't like losing, that's the safe bet. And you still get 1, 2, 3 and a half. And so we've looked at, of course, I would have gotten out here. That's my weekly objective. So 3. This is where we're getting out, 3. So 3% on a Friday. 1, 2, 3, 4% on a Thursday. That's 7. On a Tuesday, 1, 2, 3 again on a Tuesday. On a Wednesday, sorry. So that's 3, 4, 3, and then if you caught the move on a Tuesday when it began, if you were lucky enough to catch it when it began, 1, 2. So 3 plus 4 is 7, 7 plus 3, so that's 12% on offer, trading it as a day trader. If you traded it as a weekly trader, that was 1, 2, 3, 4, 5.5% on offer. Either way, you make bank. And the beauty of it, this way is you put it in once and it's gone. You don't have to worry about it for the rest of the week until it reaches your level. So maybe you would have been out there for a quick 2-to-1, and then you've been back in here again for another 2.5-to-1. So 4.5, 5-to-1 in 2 goes. If you're a day trader, you don't have to be an everyday trader. That's something one of my mentors used to say, Michael Huddleston. Being a day trader doesn't mean you're an everyday trader. And so you can get your 2% on Tuesday and walk away, or your 3% on Wednesday and walk away. If you miss Tuesday or Wednesday, you come on Thursday. So you got 4 cracks at the market this week based on the direction. And the same thing played out, I've shown you on the EU, played out on all the majors. Let's look at GU. Same principle, right? It dropped down. This here was just to show what happened using the US dollar. But you can see here that the GU took off on a Monday. And how would you have known where it would have taken off? Let me open another chart real quick. Let me just do GU real quick to show you an example of how you work it out, even if it doesn't follow the US dollar's timing. Right, so that's the week. I'm just going to do this real quick. I'm not going to talk through it now. I've got to be done in 10 minutes. And so there are signals. The week is formed. There's a turning point. The previous week, so we wouldn't have seen that. We'll have just seen this. The previous week broke our engulfing line. It also broke this here. Can't be bothered with that. It also broke that there, but we're not going to bother showing that because that didn't work. Now, in this case, it had already taken out the high. That's important because the fact that the previous week closed above that high tells me price is very unlikely to want to come down back into that level. This is the level it's likely to respect because it's violated this liquidity. It doesn't need to come back into this liquidity pocket because there is another liquidity pocket there. So it's going to come back in there. And then the third level that I'll be looking at in terms of engineering, engineering the intra-week liquidity would be this one here, the high of that candle. So those are my 3 levels I'm looking at for engineering. In terms of objective, the fact that we came in here with this much momentum tells me this is likely not to be respected, but I'm going to put it out there just in case to see what happens when it gets there. If it gives me an intra-week signal around that level, it could also be a level to reload if I miss the entry to go long from. But then the levels I'm really concerned about are this one here. You can look at that. See, I mean, if this doesn't tell you that we're onto something, I don't know how to help you. Look at that there. Look at that. Where that body, perfect to the pip almost. But without trying to be Nostradamus, because I'm not trying to be Nostradamus when I'm trading. I like to be Nostradamus when I'm predicting. But when I'm trading, I want to give myself some room to be wrong or not to be so precise so that I can still make my money come in and come out. So those were my levels. I've closed out my G chart, and I didn't trade GU this week because of the Brexit news. I just thought stick with the one that I was sure would be textbook, which was EU. And so that happens there. I dropped down to a 4-hour, like I've shown you. First of all, look at what's happening in the 4 hours. Look at all those levels. Look, see. Can you see that? Ain't that beautiful? Ain't that beautiful? If you're a technician, this should give you the heebie-jeebies. Anyway, the week starts there. It started up there. Where did it drop down to? It dropped down to this level here, right? Like we predicted. It dropped down into that level there, right? And now what are we looking for? We're looking at stop hunts. Now you see here that you don't find a 4-hour stop hunt. There is no clear, discernible 4-hour stop hunt in this region, which is why you may not have trusted this. But, and then of course, you see a rejection from this level. This is why I didn't want to trade GU, because a lot of this wiki stuff here was caused by Brexit sentiment, fundamental news. But when it comes back down there and it still pushes back above that level again, boldly, you see here, even though it's not a stop hunt, but it's a liquidity run. It's still a run on liquidity, because while it's not taking out a low, it's dipping back into an old high, and there will be liquidity in this level. Why? Because people who took a long here, breakout traders, would have put their stop somewhere in this region, because this is their entry there. And so it's going to tap into that there. And I'll also show you on a lower chart. So this for me would have been a valid signal. That's another style of trading that I haven't shown you yet, but we will get there. I'm starting you off with the easy stuff first. If I wanted to trade the GU, that would have been my entry on a Monday. But then look, that's wide. That's 100 pips. I don't want to do that. So you wait. And then it goes up, right? And then you see, again, when it gets above this level, it drops back down into that level there. Same thing it did here. So that's an area of liquidity. That's why we draw that out. And again, it gives us a nice sharp reaction. When it gives us that nice sharp reaction, that didn't happen till roughly, so this was Wednesday. The moment this does that there, and it's giving you that nice sharp reaction, again, you have the choice to do this if you so desire. I don't. That's 80 pips. It would still have, look, it would still have given you a great move in terms of risk to reward, but that's not in my purview. And so I would then draw this Fibonacci down from here to here. I'm waiting for it to get to roughly 61.8. That's pretty much the difference in the spread. Once that starts to move again, the point I'm making is GU, if you're an intra-week trader, again, just look at this right here, just to show you that I'm not hedging my bets here. If we'd done this, first of all, 1, 2, 3, 4, that's a good week. If it come in here, beneath that low there, that's 2.5. If it come in here, which is, sorry, roughly where that would have been, with a stop here beneath that there, that's more. But this is where the intra-week comes in perfectly. So you drop down to the 15-minute chart. What are we looking for? We are looking for those entry and exit points. So that's Friday, Thursday, Wednesday, Tuesday. So let's look at Tuesday for starters. What happens on Tuesday? Price gets to, it doesn't go beneath it, but it takes off. leave it alone. Could you have made money here? Yes. Is it likely that you, as a newer trader, would have known how to make it? No. So yes, there was a trade to be made here. And this is a trade, for instance, it's in New York, not London. When the price comes back in New York, like I said, you can then establish that as a daily low, and that's the trade there. And they're giving you 1, 2, 3, almost 4% on Tuesday, closing up at that level there. You can see the confluence of those levels. But if you're a new trader, you don't see that, leave that well alone. Look for Wednesday. Wednesday is very clear. We're looking for a long, so we're not bothered about this, especially because this is so close. This is perfect manipulation using a weekly level, and it drops and it comes back down here. You could have entered there and lost some money, but like I said, I'm looking for, so you could have entered there and lost some money, but then this one is pretty much perfect. And so you're going, but this is what I would have done. Shape, rectangle, this is the area of liquidity I'm looking for. Remember I said you have to have a reference point from the previous day usually. Where's price likely to come back down to? Under this stop hunt here, this is the level it's likely to come back down to. There you have it. And so that's your entry. You see these on my chart all the time, those boxes. That's your entry. So the spread would have taken you in here. But even if it did, definitely here. And so you go 1, 2, 3, 3.5. Or if you miss that, you wait for New York. This is the New York retracement, right? It violates that low there. And so that's the New York entry, just one. But then you, now on Thursday, sorry. Again, we're looking for a long. So we're waiting for it to come out and react somewhere. Where do we want it to react? A previous day. So this would have been one option. Really got to finish now. This would have been one option here. But as price approaches there, what's it doing? It's not slowing down on the 15-minute chart, is it? It's bomb rushing it there, right? Also, I like to look for the middle of this. It's just coming through real quick, and there's that level there as well. That tells me be very careful. There's likely to be a stop hunt beneath that level there. And also there is a stop here. So I want to see it take out a significant, so, you know, again, you could have lost money. I don't want to quibble about it, but it looks really nice in hindsight. But this, for an experienced trader, would have been the trade. And there you go. 1, 2, 3, 4, 5. Or if you wanted to wait for the candle to close, 1, 2, 3, 4.5. Now this is one of those beautiful ones where New York gives you another chance, because see, if you miss that there, right, and you sit through New York coming all the way back down, and it comes back down to that level there, and at that level gives a nice sharp reaction. So this would be the reaction. You're in there. Your stop loss is now beneath what you consider to be the low of the day, and you're still going to get one again. And then finally on a Friday, the same thing on the Friday, it violates it just by a little bit and then gives this screaming reaction. And so we are going, again, we're looking for a reference point from the previous day. The point at which it gives the reaction, that's the reference point. You wait for it to come back down. That's always the key, to come back down to that thing there, that order block there, or demand zone there. And you got 1, 2, and a 3. So that, my friends, is how you kill the market. We're going to stop this analysis session there. I'm going to do a cast forward session later tonight or tomorrow. Bless you guys. Bye-bye.